So far, we've been talking about the price of consumables, right? Whether that's a commodity or whether that's something that you're going to, buy and then use. But one of the most important things that people buy and sell are assets. And so assets are things that provide value over a longer time frame, right? So if you buy a sandwich for lunch, it provides you valuable value for that lunchtime. But if you buy a house, it provides value for a much longer period of time, right? If you buy a car, it provides you value for a longer period of time. And so we can think about, people buy assets both to take advantage of those services, right? They get the benefit from owning it. If you have a house, it provides you housing services. If you have a car, it provides you transportation services. And to be able to sell it later, right? So if you buy a car as opposed to, say, leasing it, then you are able to sell it later. If you buy a house, you have that asset. You can sell it, if you need to move or if you want to move. And so the value of a financial asset is a little bit different than, say, the value of a ham sandwich. And so if we think about a financial asset is going to be things like stocks, bonds, mutual funds, etc. It's going to depend on the size of the cash flows, right, that it's expected to generate. That's going to be things like dividends for stocks or interest payments for bonds, and the uncertainty, right, the risk in those flows. So, and it will also then depend on, what you think it will be worth when and if you sell it, right? So if you buy a stock, uh, you probably plan on owning it for a while, but you may not plan on owning it forever. And so the value that you sell it at in the future is also going to be important in terms of what you're willing to pay right now. So we'll look at bonds first. A bond is basically just a loan, but it's a loan that is the same for everybody. So if Coca-Cola sells bonds or if the US government sells bonds, you're basically lending money. Whoever buys those bonds is lending money. And then the bond itself promises to pay interest, right? A fixed amount of money at specific times. And the problem, so the big risk with any loan is that you won't get paid back, right? If you loan money to your brother-in-law, the question is he going to pay you back? And the same is true with bonds. Government bonds, the risk is usually much lower, although that's true for some governments more than others. So the United States government bonds are virtually risk-free, but nothing, of course, is really risk-free. Whereas some government bonds come with a lot of risk, or at least more risk, because they will either default, or the other way that the government can reduce the value of the bond is by increasing inflation and sort of decreasing the value of those payments. Corporate bonds are not risk-free, right? Some are very safe, some are less safe. They have ratings, right? AAA rating is the most safe, and then they usually go down to like C rating or B rating, which are higher risk of default. Um, and so if the riskier it is, the lower the bond price is going to be, which means that you get a higher interest rate, right? So if you are willing to take on that risk, you have to be rewarded for it, and you are rewarded for it by by receiving a higher interest rate. Stocks are a little bit different, right? So a stock is a piece of ownership on the firm. So the publicly traded firms are owned by their stock holders. So if you own one share of Coca-Cola, you own a tiny piece of that firm, and you have a claim on some of its profits, right? And so basically the firm will decide how much of its profits it should reinvest in the firm and how much of its profits it should pay as dividends. And so a dividend basically pays the same amount for every share that you own. So if the dividend, for example, is 25 cents per share and you own 100 shares, then you will get $25 for those shares. Um, Firms that are more profitable or that are expected to be more profitable in the future will have a higher share price than firms that are less profitable or are expected to be less profitable in the future. So risk is important both for bonds and stocks, but really for any asset that you're buying. And it all depends on uncertainty, right? how profitable are these firms going to be? How likely is it that I get paid back on the bond? And so there's different kinds of risk. So systematic risk is risk that applies to everything. And so if you think about the Great Depression or you think about the Great Recession, sort of systematic risk in almost all financial assets fell in value. What we saw things like gold prices going up in the Great Recession, which is not a financial asset at all. It's kind of where people sort of park their money when they're worried about risk in the financial markets. And because so many people wanted to park their money there, the price went up. Idiosyncratic risk is risk that only affects a given firm or asset, and you can diversify that risk by buying some protection, right? So if there's assets that one goes up when the other goes down, then you can buy them both to insure yourself. And there are even assets that are created by the financial markets, things like credit default swaps, that they're basically insurance on the value of those assets. If you, for instance, the bond defaults, then the credit default swap pays you a certain amount. So the rate of return depends on the market capitalization rate, right? That's the market capitalization rate. It's higher for companies subject to greater systematic risk, and it's lower for companies that are not as subject to greater systematic risk. So if you think about, safe firms, things like utilities that have monopolies, they have sort of almost a guaranteed profit level, but it will never be super high, right? So they tend to have less risk, but then there's also less upside. And so they'll tend to be priced lower when buyers are less optimistic and priced higher when they're more optimistic. So trading strategies vary, and it's interesting, so the rational economic theory is that the value of securities, whether we're talking about stocks or bonds, depends on some fundamental value, right? And so that's going to be based on anticipated future earnings, right? So what are those dividends going to be? What are those interest payments going to be? And the level of risk, especially systematic risk. And trading strategies, you can buy assets that are priced below their perceived fundamental value. Of course, you have to be able to calculate that fundamental value. So you can think of that as sort of the Warren Buffett strategy. Or you can look for momentum in asset prices, right? So if a price is going up, you want to try to buy it while it's going up, and then if it's going down, then you sell it before it goes down any further. You can sort of think of that as like the day trading idea of asset prices. Both are a form of speculation. Obviously, the first one tends to be more sort of long-run speculation, where the second one tends to be more short-run speculation. But they're all speculation. I would argue certainly that the fundamental value of a security can never truly be known. There's too much uncertainty, there's too much risk, and so while you might be able to estimate it well in the medium run, whether that's 5 years or 10 years or 20 years, in the long run, 30, 40, 50 years, it's almost unknowable. The way that financial markets are generally cleared is by a mechanism called a continuous double auction. And so this is a little bit esoteric, but it's important to know if you are going to be a buyer of financial assets. And basically what it does is that it says, all right, well, if I'm buying, I have to say how much I want to buy and at what price I want to buy. And if I'm selling, I have to say what I want to sell and at what price I want to sell. And then as soon as there's any overlap between the bid, those are the orders to buy, and the asks, those are the orders to sell, the trade is matched and it takes place, right? And it's always, the price is always adjusting to reconcile supply and demand, right? And clear the market. So if all of a sudden there's a lot more bids and fewer asks, then the price is going to tend to go up. If there are a lot of asks and fewer bids, the price is going to tend to go down. And this is really the same type of equilibration through rent seeking that we saw earlier in the product markets. So this is what a typical continuous double auction might look like. So we have the bid orders here ranging from highest price a buyer is willing to pay to lowest price. And here are the asks ranged from lowest price a seller is willing to accept to the highest price. And there's a good video from the textbook, which I'll post with Rajiv Sethi, who's more of an expert on this, sort of showing how those markets clear, right? So if all of a sudden there's a bid for 1660 for 500 shares, then that would be matched with this price, 1659, 500 shares, and that would disappear. If it was for 1,000 shares at 1660, then the buyer would get 500 shares at 1659, and then 500 of these 700 shares at 1660.